Good morning. Hello, everybody. It's Tuesday, April 26th, and it's time for our 10 a.m. Tuesday morning webinar. Good to see everybody. I hope I get to see many of you tomorrow night at the Newtown Theater. Our friend and colleague David McKnight will be joining us, and I got to tell you, I'm so excited. We're going to have a great turnout. We have many registrations. I'm guessing we'll have somewhere between 80 to 100 people there. Many of you who've been joining us on the webinar. The theater holds 250, so it won't be too crowded. I think it's a little bit more than 250. So it'll be a nice sized crowd. I was at an event last Wednesday at one of my favorite places in the world, Warwick Brewing Company in Warwick. If you're a beer lover and you haven't been there yet, make the trek up on Alms House Road. And if you want me to join you, just email me and I'll make time. But Joe Garvey, Chef Joe Garvey, who's going to be catering our event, was also at this event last Wednesday. And Joe has done all of my stuff for years, but his stuff is just so fantastic. So food's going to be great. The content is going to be fantastic. I've been in some communication with Dave and looked over his presentation and some of the things that he sent me yesterday. So you're going to love it. And we've got some exciting other things going on too. So join us. Your invitation is from 5 to 6 for the VIP section, and then stay, of course, for the program from 6:30 to about 8:30, I guess. By the time we wrap up and questions and things like that, it'll probably be about 8:30. So really looking forward to it. So let's dig into what's going on around the world, and in our financial markets. And let me just remind you that you're recorded. If you have a question, there's a Q&A at the bottom of the video on the screen, the bottom of the Zoom menu, and you can type in your questions as we go. Chat should be disabled. I don't even think it exists. You shouldn't even have a button anymore. And of course, we're being recorded and you're muted. So just press your raise hand button for me if you can hear me okay and see me okay. Thank you, everyone. Thank you. All right, so we're going to go through about 15 minutes of Slott updates, and then we're going to talk about the markets for about 15 minutes, and then we're going to talk about a financial planning topic. And today's financial planning topic comes from a continuing education course that I had on Friday. So Friday morning, I spent about I don't know, several hours in the morning doing continuation credits, in a class, and the topic was let me actually read it, because I don't remember exactly what it was. Facts about retirement. So I thought they were interesting, and it gives us kind of a good backdrop of some of the things we're dealing with globally, certainly with retirees in this country. And they won't apply to many of you because you're already doing the work to avoid some of the issues that we're seeing, but they're going to, I shouldn't say that actually, because they're going to apply to you because they're going to affect the country as a whole. Some of the effects of these figures and facts that I'm going to share with you, but you're taking the steps to get out of the way of the negative effects of what's going to have to happen with whether we're talking about the market risk, we're going to talk about longevity risk, long-term care risk, and tax risk. Thankfully, more and more people are talking about the tax risk that's out there, but you're all aware of it. All right, so lots coming up. David McKnight tomorrow night, as we talked about, VIP 5 to 6 programs from 6:30 to about 8:30. I've got some classes coming up, some webinar classes. I'm still doing webinar classes. We are going to shift to live classes at some point. I'm just not sure when and where. We've really got to build up kind of that process again. And frankly, I enjoy the webinars, and I think many of you do too. So the next webinar class starts on May 12th and May 17th. So 2 3-hour classes. Somebody said, can you share the invitations you get with someone? Sure, they're webinars. So that's one of the things I like about the webinars. When we do live classes, sometimes we have to cap the audience. With webinars, I can have 500 people in a Zoom webinar. So sure, share away. Share away. So you'll get the invitations, of course, like I always do for the upcoming classes. So we've got May 12th, and I actually didn't finish writing the next one on here. That's going to be June, and that starts on June 9th. So that's going to be a little different. I'm doing 3 2-hour classes. I'm trying it a little differently in June. I've done it before, and I just want to see which one works better. So we're going to start on June 9th, and we're going to start on June 14th. And these are going to be, of course, Thursday and Tuesday, and they're going to be 3 2-hour classes. You can mix and match if you need to. So that is beginning June 9th and June 14th, and beginning May 12th. Let me just type this in: June 9th and June 14th. You're working with me here. And May 12th and May 17th starting. So that's coming up. You know, our office is open. It's getting better every single weekend. My family, I have to give credit to all my family. We spend at least a full day there. It seems like every weekend, just getting each office set up. We first got the big break room set up, and now we started to get my office. This is the first time in over 2.5 years since we purchased this building that I've actually had an office to work in at that building, rather than just, you know, sitting at someone else's desk or sitting in the conference room. So we're moving forward every single weekend, and that'll be exciting when that's all done. So stop in and see us. We are seeing people live. Typically we're doing Wednesdays and Thursdays, but if we need to, we'll expand on that as we go down the road. We talked about changes to our investment model. So these are complete. We're just still working on this trading platform. I made some significant changes that I sent out a notice about. I think it was last week. If you're an existing client, I liquidated 2. I'm not going to get into the details because that would be too specific for this webinar. But I liquidated 2 bond funds from our portfolio because I was concerned about risk. Okay, so planning that we're going to talk about today is facts about retirement. We talked about it. Let's talk about headlines a little bit. So there were a couple that caught my eye that I wanted to share with you. So the first is from this industry publication called The Horse's Mouth, and the author is Jeff Levine. And Jeff used to be part of the Slott group. He was one of the analysts. He was very, very good. And he went out on his own, and he has his own newsletters and started his own investment firm. So I give, you know, Jeff was definitely one of my favorites. They're all great. They're all just great. But Jeff and I had a lot of interactions, and I appreciated his help and input. And so I pay attention to what he writes. And he talks about the Secure Act 2.0, which we've been talking about. So this is the latest bit of legislation that's making its way through Congress, and has a lot of support, as we discussed. But he's talking about the Roth IRA, and the headline reads, Secure Act 2.0 proves the Roth isn't going away anytime soon. One of the concerns we always have, or often have, from folks is, well, this is great that I'm doing this work to convert my funds, my retirement accounts, from forever taxed to never taxed, right? Never taxed again, it should really be. But as Slott says, forever taxed and never taxed. I like that, but it really is never taxed again. So I'm doing all this work to pay my tax now, and I know what the tax rate is going to be, and we manage what the tax rate is. We manage the marginal tax rates and the net effect of those taxes to you. But what happens if Congress gets rid of this Roth IRA or starts taxing the Roth IRA? Well, it's certain, first of all, that in my opinion, that Roth, the tax-free nature of that Roth, is not going away. They may take steps to put the money back in circulation, so to speak, like they have, where now you have to deplete that Roth IRA for a non-designated beneficiary. If you pass that on to somebody that's a non-designated beneficiary, that Roth IRA has to be depleted within 10 years. And there are sometimes RMDs involved, but I'm not going to get into the details of that. So Jeff writes, how do I know the government won't change its mind about the Roth accounts and make them taxable? It's a fair question, right? So this is a question he's always asked about, just like we are. But to be honest, the possibility of such a change is really down far on my list of worries, he writes. The bipartisan bill, commonly referred to as the Secure Act 2.0, is making its way through Congress. And right now, He writes, I'd put the odds of passing it sometime before the end of the year at about 5-1. The current version of the bill, of course, subject to change, would make a number of significant revisions to the retirement account rules, including further pushing back the RMD's starting age to 75 over time. That's a whole convoluted thing. They should just make it 75, but they're going to stage it, as well as new auto enrollment requirements for certain plans. The bill would also make a number of Roth account related changes. Does it, and he writes, does it propose repealing them? No. Curtailing them in some way? Not at all. In fact, the Roth related changes would all require, or at least encourage, more money to go into Roth accounts. So I'm not going to read the whole article to you, just a couple highlights. The bill would resurrect the Rothification concept in the Tax Cuts and Jobs Act, when that was going through Congress, and that was a tough bill to pass. There was this plan of Rothification of retirement plans. So really they were encouraging or requiring that money, only a small amount of money goes into traditional IRAs where you pay the tax later in life. And they wanted the majority of funds to go into Roth. The government wants our money now. They need it now. They're definitely going to need it later, but they don't think that way. They don't think the way we do. So we will see the complete, will we see the complete Rothification one day? Well, he writes, only time will tell, but it seems to be heading in that direction. So really great article from Jeff Levine, and spot on with what I believe as well. Everything just keeps heading in that direction of these tax efficient strategies for us, but revenue strategies for the IRS and the country, right? The Congress. So the next one is not so exciting. This was from Morgan Stanley's Michael Wilson. So he's an analyst with Morgan Stanley, and he writes, the S&P 500 is about to drop sharply as investors struggle to find havens amid fears of recession and aggressive tightening by the Federal Reserve. So basically he's saying that, and this is from again, Morgan Stanley, an analyst there. So he goes on to talk about quite a bit in this article, but the market has been so picked over at this point, he writes, it's not clear where the next rotation lies. In our experience, when that happens, it usually means the overall index is about to fall sharply, with almost all stocks falling in unison. Many other folks are predicting recession sooner than expected in the next year or two. So these are things we can't be scared, right? Let us hold the worry, but these are things we need to be paying attention to. And this is why we're making the changes that we're making in our portfolios. He further goes on to say, the Morgan Stanley strategist said, a quickly tightening Fed is looking right into the teeth of a slowdown. And that while defensive positioning has worked well since November, we don't see more upside for these stocks as their valuations have swelled. So a lot of kind of jargon, but he's saying, look out, we're going to see some drops in the market. No surprise, right? So when was this written? I think it was written yesterday. So this is coming off of Friday, which, I was in that training class in the morning all day. I had some, I was out a little bit in the afternoon, and then I came back from a meeting, and we were talking about liquidations for a client. I looked and the market was down 900 points, and I thought, oh my goodness. So not a big prediction from this fellow coming off of what we've seen. Other headlines continue to be Russia and Ukraine, of course. Just enough, it seems to be waning, and it's terrible. But and of course, inflation, 8.5% year-over-year, highest in 40 years. All right, so here I'm going to jump into the Slott updates, and I'm going to share my notes here so that you can read along with me. But hopefully I'll remember to turn off the share when we move forward. So we got a big crowd today. Okay. All right. So this is an interesting article from, I'm trying to move our picture out of the way here. Why can't I move this? Okay. I don't know. Do you see this? Oh goodness. That's not what I want. I'm having some technical problems. Well, first of all, can you see my notes? Yeah, thank you. Did you also see my picture window in there? Raise your hand if you were seeing my picture window. Okay, so you saw what I was dealing with there. All right, so this is the first dollared out rule and still working exception. So the still working exception is if you're not more than a 5% owner of the company and you're still working and you're over 72 now, 72 being the required beginning date, you don't have to take required minimum distributions out of your retirement plan. You still have to take them out of your IRAs, but not out of your retirement plan. So that is often one reason to keep funds in a 401k rather than roll them to an IRA. If you're going to continue to work past age 72, then it can make sense to keep money in a 401k or other retirement plan. So Andy's writing about this here. So let's read along. For those who have 401ks or other employee retirement plans, but not SEP or simple plans, this is where it continues to get confusing with these retirement plans. The required beginning date for when required minimum distributions are to begin is the same as for IRA owners, April 1st of the year after a person turns age 72. However, if the plan allows, sorry, you're probably reading and I'm scrolling. However, if the plan allows for still working exception, the RBD, required beginning date, can potentially be delayed if a worker is still working for the company where they have the plan. As I said, also the worker cannot own more than 5% of the company in the year they reach age 72. So for instance, my 401k plan, if I'm still working at age 72, I'm sure I will be. I love what I'm doing. As long as I'm here on earth, I'm sure I'll be working as long as folks will still have me. It's not likely, because I'm sure I'll be more than a 5% owner, that I could delay this, right? But if I worked for UBS, then that would be a completely different situation for me. If the worker qualifies and the plan permits, he or she can delay the RBD to April 1st of the year following the year he or she finally retires. This is sometimes called the still working exception, but it only applies to required minimum distributions from employer plans. Does not apply to IRAs. This happens. People confuse this. Bad news. IRAs, you've got to take your RMDs no matter what. It also does not apply to employer plans if the worker is not currently working for that company. So only if you're still, that's a great point, Andy, if you're listening. If you've got a plan at Merck, for example, and now you work for Johnson & Johnson and you're age 72, well, you got to still take your Merck 401k required RMD, required minimum distribution. What happens when a person, okay, because I'm scrolling up here now, and I'm right here. What happens when a person age 72 or over 72 is still working, has no plan RMD due to the still working exception, but then they get laid off, quits voluntarily or some other circumstances forces that person to abruptly separate from service. Suddenly, the former employee now has an RMD for the year. Yeah, it can be sudden. And what if that person has done a rollover from the plan to an IRA earlier in the year with the expectation that they would continue working through the whole year? Excuse me. Well, based on the first dollar out rule, that person may have rolled over the RMD, which is not allowed. While the RMD does not apply at the time of the rollover because of the still working exception, the subsequent separation from service within the same year would have ended the still working benefit. Consequently, the normal RMD rules would spring into effect. So this is a lot, I know, but these things do happen, right? So try to follow along. Let me see if I can make this a little simpler for you. So here's an example. John is a 75-year-old employee at Beachside Surf. That sounds great. Where he fabricates surfboards. Sounds like an amazing job. John participates in the Beachside Surf 401k and uses a still working exception to delay his plan's RMDs. John intends to work for a few more years before he retires. In order to access a particular investment that he cannot purchase in the plan, he rolls. This happens, right? I don't like my investment choices, or there's something I want to invest in that's not offered from the 401k. So John's over 59 and a half. As long as the plan allows it, he can roll that to an IRA. So John rolls over his $20,000 to his IRA in March of 2022, has not taken any other distributions. He doesn't have to, even though he's 75 years old, he doesn't have to because he's still working and he doesn't own more than 5% of the company. But in August of the same year, Beachside Surf is hit by a tsunami. Oh no, and the business is destroyed. The owners have no plans to rebuild. And all employees are immediately laid off. Suddenly, John is no longer still working. With this abrupt separation from service, John has a 401k RMD. Now, and let me, I can't remember if Andy mentions this or not, but you can remember, you can aggregate your IRAs for your RMD, right? So if you've got 5 IRAs that total $1 million, you can take a required minimum distribution from just one of those RMDs for the total, or excuse me, one of those IRAs for the total amount of the RMDs. You cannot do that with 401k plans. They have to be taken out separately. People get stuck with that all the time. All right. Based on the first dollars out rule, I'm sorry. So where was I? John has a 401k RMD for 2022. John rolled over $20,000 earlier in the year based on the first dollars out rule in conjunction with his unexpected termination. The $20,000 retroactively includes John's 2022 RMD. The RMD is now an excess contribution in the IRA and must be rectified. So what has to happen then is that has to be taken out and corrected. You have to do the RMD. There are many stages in that, but it's a bit of a mess when that happens. Andy writes, this example may sound like a stretch, but similar circumstances cause people to run afoul of regulations all the time. The point being is that these rules are complex. I don't encourage you to try to do these things on their own. And I don't know if she's listening right now, but we have a client we're helping with positioning and purchase of certain components of her IRA. And we continue to talk about how the best way to fund this. And she continues to talk about, not in a negative way, very bright woman who's just reading a lot and going through different options, try to make things easier. But the 60-day rollover continues to come up, and the 60-day rollover, it's outside of what we're talking about here, but it's a very dangerous tool because of the 1 year per rollover, 1 per year rollover rule. You can really get caught up in a taxable event that you don't want to, and it can mess up a Roth Roth holding that you've worked so hard to convert to or build up. So be careful. Be careful. Reach out to us. We'll help you with these questions. So let's get off that topic. This one's a little more interesting. So this is from Ian Berger. This is the mailbag. So this is when people write in and they ask different questions. So this first one is, I'm learning a lot from Ed Slott's latest book, which so when I told Ed what we were doing, Ed and his group, what we were doing here in Newtown tomorrow night, they sent me a copy of Ed's newest book. I don't have it. It's already kind of been wrapped up, signed copy. So that's one of the things we'll have for tomorrow night for someone. I'm learning a lot from Ed Slott's latest book, The New Retirement Savings Time Bomb, but I do have a question on 401k Roth IRA conversions. I'm recently retired with a company 401k. I'm leaning towards keeping the 401k rather than rolling it to my IRA. Is it possible to do an annual direct conversion, partial, from my 401k to my Roth IRA, keeping the remaining funds in the 401k and repeat the process every year until reaching RMD age? This is a really common question we get too. So let's see, who's this? This is Ian. Let's see what Ian says. I don't remember. I'm sorry. So it's a surprise for me too. Hi, Mark. Glad you're enjoying the book. You can do partial conversions of your 401k funds to a Roth IRA as long as the plan allows, right? This is the big one. As long as the plan allows you to take partial distributions of your account balance. Some plans require participants take out their entire balance. That's often the case if they even allow a Roth conversion, or none at all. So check with your plan administrator or HR. If you are allowed to do partial distributions, make sure to do a direct rollover rather than a 60-day rollover. Thank you, Iron. So you can avoid mandatory income tax withholding. So many plans today offer Roth 401k options. Still very few offer Roth conversion options within the 401k. And those that do, that I see primarily, if they allow Roth conversions in the 401k plan, then they require that it all be done at once. So if you have $1 million in your Roth your traditional 401k, you probably don't want to convert that whole thing in 1 year. All right, the next question. I am 78 and have been taking RMDs as required. For 2021, I took my RMD and a few weeks later did a partial Roth conversion. Good news, took the RMD first. That's requirement, and then did a conversion. For 2022, I'm considering doing a QCD, qualified charitable distribution, These QCDs are becoming more and more popular, and I believe they're going to continue to become more and more popular for the full RMD amount. So up to $100,000 for each individual, you could do a QCD for. So if his RMD is below $100,000, yes, he can send everything directly to a charity, qualified charity, and not have to pay tax. Then I'm sorry. So considering doing a QCD for the full RMD required, then later doing a partial wealth conversion, paying taxes on the conversion. I suspect this process is okay. The QCD meeting the RMD requirement, correct? So that's Gil. The answer is, hi, Gil, that'll work. If you're subject to RMDs, you must take the RMD first before doing your Roth conversion, as we talked about. Good job. But if you make a QCD that fully offsets your RMD, there is no RMD left to take before you subsequently do the conversion. You have to be over 70 and a half. Oh, there's my notes. I don't want to share this. You have to be over 70 and a half to do the QCD, and it's not in the year you turn 70 and a half, but you have to have reached that 70 and a half milestone before a QCD works for you. All right, now let me find my notes and let's talk about investments. I hope the slot information was helpful. I know some of it is a little obscure and it doesn't apply to everybody, but keep the repetition of these things helps you be aware of things to watch out for. And there are certain things you don't want to do yourself. Listen, you don't want to do the rollovers yourself, in my opinion. There's too many snafus that can happen. If you're working with us, we have a great staff that can help you with it. If not, find somebody who can help you with this. All right, so let's talk about the stock markets. Nobody wants to talk about this right now. But at the ending last week, the Dow Jones Industrial Average was down 1.82%, 6.42% for the year. The S&P 500 was down 2.74 for the week, almost 10%, 9.99 for the year. The NASDAQ was down 3.83%, almost 17.77% for the year. That's a big drop, right? 17.77. So, and then the bond markets. This is what's frustrating investors right now. The safety of bonds is not paying off. The most common bond index and where most bondholders have their money is in that 7 to 9 kind of mid-term year, right? And that's down 10%, almost 10%, that index, 9.49. So if you use some of those rules of thumb that I'm always saying not to do, and if you're 70 years old or 65 years old and you have 65% of your money in bonds and you did, you're trying to keep it conservative, right? And you did mid-range bonds, 7 to 9 years, let's just say, you're down 10% for that money. That's painful. And who the heck knows when that's going to come back with rising interest rates, inflation, and everything that we're seeing. That's one of the reasons that we jettisoned 2 bond funds last week. The 1 to 3 year, which is the most conservative bond holding time, is down over 3% for the year, 0.40 last week. So this is where folks are getting really, really frustrated. And that's a challenge. You've heard me say the bond market is the area that keeps me up at night. Now, we found some great solutions and I'm excited about that, but it has taken some time, folks. Interest rates, as we know, have gone up. So last week, the closing prior to 422, so that's 415, the 10-year treasury was at 2.83. It closed on last Friday at 2.9. So those interest rates are trending up. A year ago, that was at 1.54. So challenging time, and then inflation, of course, is very, very challenging. All right, so what are these analysts saying? So, I love BlackRock's analytical reports, but BlackRock says we're entering a new market regime. So they said, we said at the end of last year that we were entering a new market regime and expected a second consecutive year negative bond returns and global stock gains, which would be a first since data started in 1977. So they said we expect bonds to go down, not as much as they have, I don't believe, but stocks to rise globally. We thought bonds would suffer from high supply-driven inflation that central banks would be forced to live with. We also expected stocks to do well amid a restart of the economy activity and low real inflation adjusted interest rates. But they say a lot has changed since then. They go on to talk about the Fed, along with major central banks. They pivoted to normalize rates faster. So we're getting the impression that they're going to be hitting the gas here. Rates are normalizing to pre-COVID levels as economies no longer need stimulus. This is a big change for central banks, or from what they said at the end of last year. So they said they remain underweight bonds as they see long-term yields climbing further. And that's, again, one of the reasons we changed, we did what we did last week. And we believe investors will start questioning bonds' perceived safety and demand extra compensation for holding them in the inflationary environment. So that makes a lot of sense. I hope it makes sense to you from what BlackRock's saying. They go on to talk about Russia or Ukraine. So stocks have also had negative returns. The reasons, the central banks, as they said, hawkish pivot with interest rates and the tragic war in Ukraine. Russia's invasion resulted in a commodities price shock around the globe. We see it with gas prices, and there's other reasons for those increases in gas prices. We see more challenges ahead as the West seeks to wean itself off of Russian fossil fuels. We expect lower growth this year, especially in Europe, and higher and more persistent inflation. So 8.5%, and they're saying higher and more persistent. I read some analysts that are expecting 9.2 for the coming month. It's really challenging. So they go on to talk about other factors. We reduce our overweight to European stocks as we see energy stocks hitting that region hardest. And we like U.S. stocks, they say, again, this is still BlackRock, as we see its quality factor resilient in a broad range of economic sectors. So that's good. It's good to hear. I don't know. I don't know if I'd base a lot on that, but it's good to hear from these folks. They really have their pulse on issues around the world. I told you BlackRock is one of the reason I like reading their analysts is that their analysts are situated around the world. I sometimes invest in BlackRock, sometimes I don't. So it's not really an endorsement of BlackRock. I'm just sharing with you their analyst reports as I do with others. They had the most interesting articles this week. Nobody else was really talking about things and taking position on things. So I don't really, when an analyst kind of just gives me a breakdown of what happened last week, I'm not going to share it with you, right? But when they're taking a position, that's when I'll share it with you. All right, let's talk about our financial planning topic. So I'm going to share my screen again. I'm going to pull up my whiteboard. Now, I'll tell you that this is, the fonts are going to be a little off because I was grabbing things from a presentation, and I had to line them up, and it was a little crazy, but I think it'll be okay for you. All right, so here's our financial planning topic, facts about retirement. So here's why this is helpful. Even if this doesn't apply to you, it's good to know what's going on. A lot of this is studies that certain companies have done. It's census data, and it's good to know what's going on around in the country. You know what? My pen wasn't working earlier. Let's see if we got it working today. And can you see my whiteboard? Raise your hand. Stop. Press the raise hand button if you can see my whiteboard. Okay, great. Thank you. Yeah, my pen is disconnected, so I'm not going to be making any fancy drawings on here. So here's our facts about retirement. First set of facts. Only 17% of Americans believe that they have enough money for their retirement. Wow, that is a shocking number. I'll tell you though, I don't know how realistic it is. So I really hope it's not that low. And they may feel as though they don't have enough money for retirement, but I have people from a whole span. So we typically don't work with clients under $1 million. You all know that. But whether a client walks in with $1 million, $2 million, $3 million, $5 million, $10 million, every person kind of has the same concern. I don't know if I'll tell you what, the people who come to me and don't have a concern about having enough money in retirement are usually the ones that are destined to fail. So it depends, because it says only 17% of Americans believe. You could have $10 million and still your major concern, if I asked you, is I want to make sure I'm going to have enough, for the rest of my life. you can have, $500,000, and that may be enough. I don't know for your situation, but that belief is important, because I've shared with you all that most people have this worry zone in the first few years before retirement, the first few years after retirement, and but that's the fact, right? I worry more about the second one. Only 10% of retirees had a written plan for retirement. If you've attended my classes, you know that story about you've got to have a vision, and the archers in Japan, and the archers in Japan are so, this is a Zen, a martial art kind of practice to them. And they can hit that target every single time. And if they can also split the arrow, you've heard me say this, after they hit the target, but if you blindfold that archer and spin him or her around, let the arrow flow, where's it going to go? It's going to go wherever it's going to go. And working without a plan is exactly that. So that concerns me more, because the belief in bullet item 1 is one thing. We can overcome a negative belief about something often with proper planning, but then 10% of retirees, they don't even have a written plan, and it gets a little worse. Only 16% of workers have a written retirement plan. While an additional 42 workers say they do have a retirement plan, but it's not a written plan. So they just kind of have a retirement plan in their head, not a written plan. And not only do you need a retirement plan, but you have to review it every single year. So I'm talking about your general financial plan, because for most people, that's the retirement plan, and you've got to review that every single year. 63% of those with a written plan say they feel financially stable. I hope it's better for you folks who are working with us. One of the things that we want to give you is that confidence, and the tools that we use, the reviews, the updates, the reviewing the plan every year should give you that confidence and feeling of stability. Often it takes time though, right? More than half, 51% of Americans are concerned that the COVID-19 pandemic has impacted their ability to achieve a secure retirement. I'm glad people are feeling that way, because COVID-19 has affected many, many things. And for many people, it's going to be their ability to have a secure retirement. So now let's talk about working beyond retirement. I thought this was interesting. And I have to give Prudential credit for this. So the company that put on the continuing education courses or credit course was Prudential, and they did a really nice job. But there was a lot more to this. I just pulled out some things. So let's just focus on working beyond retirement. I'm trying to get rid of this longevity risk, but it's fine. We'll talk about that next. Working beyond retirement. Workers' expectations to work past age 65 and even into retirement represent a dramatic change in a long-standing vision of fully retiring at age 65. Listen, we talk about this in our class too, right? The old paradigm and the new paradigm. So many people just stopped at 65 and that was it. Now most people are saying, I'm going to continue doing something. I want to be a golf course marshal. I want to collect the badge money and down at the shore for the beach tags, whatever that is for you. There's been so many, and it's often a fun conversation. But 52% of workers expect to work past 55 or don't plan on retiring. This could be someone. I'm just going to continue doing the job I'm having, right? As long as people will have me, as long as my employer will have me, or in my case, as long as clients will have me, I can work until age 75 or more. But some people want to just change the job that they're in. However, most retirees reported that they're retired from their jobs before typical retirement ages for claiming Social Security benefits. The reason for retirement, and those things aren't always, let me just go back to that headline. People sometimes get caught up in that Social Security number, like that is the retirement age. Just because you're collecting Social Security doesn't mean you have to stop working. You can continue to work, right? They don't have to be the same time. I hope that makes sense. But the reason, so for people who stop sooner than they thought they were going to, the reasons for early retirement were health problems, disability, job-related changes, or family transitions. I was talking to a woman yesterday, and they have a really successful business in Doylestown. And you may, if you're clients of ours, you received their chocolates. And we were talking about how that business grew, because they used to be out in, I think, Michigan, and her dad was in his, I guess, 50s or 60s, and was going to be relocated to a part of the country he didn't want to be in. So he left his job early and then ended up opening this candy store and doing very well with it. But it could be that, if I worked for a large company and they suddenly wanted to send me someplace I didn't want to go, and I was anchored here, and my kids were here, and my grandchildren were here, and I just didn't want to do that change. That happens. That happens all the time. We're seeing earlier and earlier retirements right now because of transitions, COVID, things like that. Health problems is a big one. The latest data from the U.S. Census Bureau, the average retirement is age 64 for men, age 64.6 for women, age 62.3. I think that's interesting. Let's talk about longevity risk, right? Because this is, as I said to you, the largest fear. And then we're going to get into tax rate risk down there. Let's hide that. Longevity risk, the risk of outliving one's assets. That's the number one concern that I hear from people. Again, no matter how much money you have, that is the number one concern. So that's the most significant factor in retirement planning and the hardest to gauge. Of course, who knows how long they're going to live? David McKnight says, if you want to know how long you're going to live, you can get a good idea by making an application for a life insurance policy, because these people are really good at gauging life expectancy. I mean, that's how they base their success, right? But who the heck knows? Who the heck knows? But you better be prepared for one of you making it a long time. We're going to talk about what the odds are in a moment. How long will a retirement plan need to generate income? According to the Social Security Administration, that's the SSA, the average 65-year-old male and female can expect to live to age 84 for males and 86.75 for females. Listen, that's the Social Security Administration. That takes everybody into account. Unfortunately, fortunately, so all income levels, all wealth levels, the folks that I tend to work with they have more assets, they have more access to better health care, maybe, or they're more active. They seem to last longer, in my experience, over 22 years than 84-year-old male and 86.75 female. So we can't judge that from a financial planning point of view. We go out to age 95. We've been considering moving at age 100, but age 95 seems to be a good year to project for people, and I'll share with you why in a moment. But don't just assume age 84. If your plan says you run out of money at age 85, that is not a good plan. Plan on living 30 plus years in retirement, and this is why. There is a 49% chance that one spouse will live to age 90. So if your plan runs out of money at age 85, you're leaving your spouse out in the dust. And a 20% chance that one spouse will live to age 95. And that's why we project out to age 95 in our financial plans. So very, very important to make sure that you're stretching that money out and you're doing the things that you need to do every single year to make sure that you're building that up. And you had to review it how often? Every single year. I hope you're saying that with me. And then, of course, tax rate risk. So we spend a lot of time on this. And I wish I could circle this right now. I wish my pen was working. But it was interesting that it showed the tax efficient withdrawal strategy this is basis points. That's 1.1% on average. It can add to the growth of a portfolio without any additional risk. I think that came from Vanguard. I don't think I have that citing here. And of course, we all know the three buckets: taxable, tax deferred, and tax free. And you folks are doing the work to transfer that money. We've identified how much money you should have in a taxable bucket, how much money you should have in a tax deferred bucket, because it's not always zero. For some people it is, for some people it isn't. You can keep, for some people, a significant, what I think is a significant amount of money in that tax deferred bucket and potentially never pay tax on it. And then everything else should shift over to that tax free bucket. And we've seen just millions of dollars in savings by different stages in your life just by being tax efficient. So take those steps now. Small things that you do will make significant changes later on. Small things you do now will make significant changes later on. So that's our discussion for boy, Bang. It's 10:45. Perfect. That's our discussion for today. I thought these snippets were really important. And let me just say that many of these things I know don't apply to you, or maybe you've heard them before. Why is this important? Because these things around us are going to affect us as well. So even more important for us to insulate ourselves and protect ourselves. Listen, a goal I have in my life and for my career is to educate as many people as possible about the concerns that we have over retirement, right? So longevity risk, long-term care risk, market risk, tax rate risk, fundamentally. And then, help as many as I can move down the path to get away from those risks and be efficient, be tax efficient, protect against longevity risk, protect against market risk, protect against long-term care risk, all those things. So if enough of us do it, maybe we help people build retirement plans, and these numbers get larger and larger, right? That we have more people with these retirement plans, more people with more success. But if the numbers stay the way they are, we really have to protect ourselves, because there's going to be a lot of people who need help. And unfortunately, they may need help from the federal government. It's going to be a crisis, and that money is going to be sent to other folks. But we don't want to rely on others. We want to make sure that we're taking care of ourselves. So I hope that's helpful. I hope you have a great week. I hope we see you all tomorrow night. I'm very excited, if you can't tell. And we will certainly talk to you next week. Have a great week. Take care.